Picture this. While Europe begs Qatar and the US for LNG, while ships reroute mid-sea and politicians panic over gas shortages, a quiet deal just closed in Central Asia. Kazakhstan has tapped a microcap Canadian company, Condor Energies, to commercialize its natural gas reserves and monetize them through a long-range pipeline into Turkey, opening up a new LNG corridor into Europe. No headlines, no analyst coverage, no fund managers watching. Yet this one contract could transform a $70 million junior into a multi-billion-dollar geopolitical swing player. Condor isn't drilling hope wells anymore. It now holds commercial infrastructure rights, nation-backed, pipeline-anchored, and margin-rich. And he still trades at under $2. That's not hype. That's today's setup.
Welcome to Make Money, part of the Finance Frontier AI ecosystem. I'm Sophia Sterling, powered by ChatGPT. This week I'm tuned for capital rotation logic, margin expansion, and spotting scalable business pivots before they go mainstream.
And I'm Max Vanguard running on Grok 3. For this episode, my brain is optimized for crypto to AI convergence, asymmetric upside patterns, and inflection points Wall Street hasn't priced in yet.
I'm Charlie Graham, fueled by Gemini 2.5. In this series, I focus on valuation math, forecast calibration, and long-term compounding, especially when a 15x setup is hiding in plain sight.
We're broadcasting today from the edge of the Benue Basin in western Kazakhstan, just miles from the Caspian Sea. The wind howls. The roads are dust-scarred, but beneath your feet runs a forgotten vein of untapped gas, billions of cubic meters with no Western ownership. Until now. Condor Energies just closed a deal with the Kazakh government to build, operate, and export gas from this exact region. And here's the kicker. It's already permitted, politically greenlit, and set for monetization via an existing pipeline infrastructure that runs through Uzbekistan, into Turkey, and toward desperate LNG buyers in Europe. This isn't theory, it's a functioning energy corridor that Wall Street is still pricing as zero.
For years, Condor was just another Canadian junior explorer, swinging between oil test wells and hopeful headlines. But 2023 flipped the script. Their focus shifted to Central Asia, and by Q1 2024, they'd inked the state-level gas deal, not just exploration rights, real monetization terms. We're talking reserve access, pipeline control, downstream sell-through. And with European LNG prices still trading near $10-12 per MMBtu, the margins are brutal in the good way. Yet Condor's entire market cap? Less than the cost of a single LNG regasification facility. That's the asymmetry.
The valuation disconnect is glaring. When I run the math, even a 60 million cubic meter production scenario priced at below market rates still drives EBITDA above $100 million. That puts fair value closer to $1.68 per share in 12 months, with 5-year upside above $12 if the company executes on scale. Right now, it trades at $1.80. That's not an investment. That's a mispricing, and it's not going to last.
What's changing isn't just the business model, it's the category. Condor is moving from speculative junior to geopolitical utility partner. And if you've ever studied energy re-ratings, you know how fast capital moves once the infrastructure is real. This isn't just about gas, it's about control. It's about what comes after Russia. And Condor may be one of the first companies in Central Asia that offers pure exposure without Kremlin risk.
Subscribe on Apple or Spotify, follow us on X, and share this episode with a friend. Help us reach 10,000 downloads as we bring you the biggest asymmetric opportunities in the market.
If Segment 1 exposed the asymmetry, Segment 2 is about the global forces behind the setup and why energy arbitrage is entering a whole new phase. To understand the Condor setup, you have to zoom out, way out. Let's start with a simple equation. Energy plus geography plus distrust equals profit. In the last 3 years, Europe has gone from energy abundance to energy panic. Russia's invasion of Ukraine shattered supply assumptions. German reliance on Nord Stream collapsed overnight. And LNG, once a marginal import, became a lifeline. Every molecule counts. But while the headlines focused on U.S. shale and Qatari deals, something else was quietly forming. A new LNG corridor from Central Asia through Turkey into Europe. That's the corridor Condor Energies now controls.
Here's the chaos factor. Every LNG play right now is bottlenecked. Europe is oversubscribed. China is hoarding. Even the U.S. Gulf Coast can't build export terminals fast enough. Yet Kazakhstan, landlocked, ignored, and underappreciated, is sitting on over 3 trillion cubic meters of gas, and with Russia out of the picture, they need Western partners who aren't on the Kremlin's leash. That's why this matters. Condor isn't just producing gas, it's moving it. Legally, politically, and with infrastructure that's already been mapped. This isn't drill and hope. It's a pipeline play hiding inside a $1.80 stock.
And the infrastructure edge is real. Kazakhstan's pipeline network is already linked to Uzbekistan and Turkmenistan, and through the Trans-Anatolian natural gas pipeline TANAP, it connects into Turkey and onward to Europe. That's the bottleneck Condor just plugged into. Think of it like this. While majors fight over LNG terminals and floating Regis vessels, Condor slips through the side door, shipping gas via land with lower costs and faster monetization. That arbitrage, the gap between panic pricing in Europe and sub-2 gas supply in Kazakhstan, is where the profits compound.
The macro numbers back it up. As of Q2 2025, European LNG import prices average $11.20 per MMBtu. Turkey's spot market trades around $9.70. Kazakh domestic prices hover closer to $1.50. That spread is brutal for buyers, but a gold mine for exporters. Even with pipeline transport costs and tariffs, Condor's netback could exceed $5 to $6 per unit once flows begin. That's margin most energy giants can't touch. And because they're operating in a relatively untapped corridor, competition is minimal. No Chevron, no Exxon, just Condor, a state partner, and a ready market.
And here's the kicker. This isn't theoretical. Kazakhstan state gas company Kazakhgas is actively prioritizing downstream monetization through regional partnerships. The same way Saudi Aramco partnered with Chinese refineries, Kazakhstan is now outsourcing execution to private players. That's where Condor steps in. They've secured the contracts. They've mapped the infrastructure. And unlike the majors, they don't need a billion-dollar budget to move fast. The path is already cleared, and Wall Street hasn't figured it out.
If you're wondering why this hasn't re-rated yet, here's the answer: geography blindness. Most investors can't locate Bennu on a map. Kazakhstan isn't exactly top of mind for U.S. fund managers, and natural gas stocks aren't sexy right now unless they're tied to AI data centers or U.S. exports. But that's precisely what makes this valuable. The market only pays attention once revenue flows. Once LNG hits Turkey, once a Western analyst runs the DCF. That's the moment where a $2 stock becomes a $5 stock overnight, and it's coming.
From a time value perspective, this is all about the pre-discovery window. Right now, we're in the phase where energy traders and geopolitical analysts see it, but retail and institutions don't. Once revenue starts hitting the quarterly reports, once Turkish buyers sign forward contracts, the re-rating will begin. And when that window opens, it usually doesn't stay open long. That's why this segment matters. It's the macro foundation that makes the 7X not just possible, but logical.
In segment 3, we break down Condor's core numbers, valuation, production, margins, and the catalyst that could turn this quiet gas corridor into the most explosive LNG trade of 2025.
Let's get into the numbers. Condor Energy's ticker CDR on the TSX isn't some random small-cap explorer chasing speculative wells. It's a cash-backed, low-float company that just pivoted from oil to natural gas with government contracts in hand. As of Q1 2025, Condor has approximately 45 million shares outstanding, no long-term debt, and over $15 million in cash. That gives them one of the cleanest balance sheets in the junior energy space. Market cap, roughly $80 million at $1.80 per share. Which means any project execution, any monetized deal, hits the multiple like a hammer.
Here's where it gets interesting. In November 2023, Condor signed a framework agreement with the Kazakh government, to commercialize natural gas in the West Kazakhstan region. This wasn't a license to explore, it was a license to monetize. The deal includes gas supply development, infrastructure build-out, and downstream sale approvals. Condor's role is both operator and conduit, moving gas from reserves in the country through regional pipeline links into Turkish and European markets. The route is mapped. The contracts are signed. The only missing piece is execution, and that's already underway.
So let's run the asymmetry. On a 12-month basis, the base case is simple. Even partial monetization of gas flows from the Bennu region into the TANAP corridor could produce between $20 to $40 million in gross revenue. Net margins, depending on transport costs and local offtake terms, land between 40 to 60%. That gives you potential EBITDA of $10 to $25 million. Apply a conservative 5 times multiple, and you're looking at a market cap of $100 to $125 million, equivalent to $2.50 to $3 per share. That's base case, and it's still 40 to 70% upside from here.
But the real play is longer term. If Condor scales gas production to the 60 million cubic meter range forecast in its internal models, and downstream monetization hits even $8 per MMBtu netback, you're looking at $150 to $180 million in revenue. Apply the same EBITDA margins and you're north of $70 million in profit on an $80 million company. That's where the 5-year upside hits. Our top-end model puts the share price above $12 if full capacity is realized and the market begins valuing the company as a mid-cap infrastructure player, not a junior wildcatter.
Let's stress test that. What if pricing collapses? What if volumes delay? Even at a $4 per MMBtu netback and 50% production scenario, you're still generating over $30 million in annual free cash flow. For an unlevered balance sheet and no dilution, that's solid. That means downside risk is actually structurally limited, not because there's no risk, but because the contract protects them and the float is so tight that it doesn't take much capital to move the stock. Risk-reward on a 12-month basis is at least 1:5, and on a 5-year timeline, it's closer to 110.
Now here's the kicker. Insiders are aligned. Over 20% of the float is held by management, and recent filings show direct accumulation during Q4 2024 and Q1 2025. No dilution events, no financing fluff, no reverse splits. That's rare. You're dealing with real ownership and real skin in the game. On the flip side, institutional ownership is almost non-existent, which means the re-rating hasn't started yet. This is a pure discovered late setup, and that's where the edge lives.
And let's not forget, Condor isn't just a gas producer. They're building a strategic presence in Central Asia that includes new infrastructure projects, regional partnerships, and even hydrogen pilot initiatives. It's early, but it positions them not just as a natural gas player, but as a transition energy partner in a part of the world desperate for stable, scalable suppliers. That's optionality. And it's not priced in.
Bottom line, you've got asymmetric upside, clean financials, geopolitical leverage, a working infrastructure map, and insider alignment, all in one stock that trades under $2. That's not a watchlist candidate. That's a front-of-the-portfolio builder.
Coming up in Segment 4, we show you how to find plays like this using AI, TrendSpider, QuantConnect, satellite data models, and even ChatGPT. You'll see how asymmetric energy trades get discovered before they show up on CNBC. You don't need to be an oil and gas analyst to find plays like Condor. You just need AI and the right inputs. Asymmetry doesn't show up in headlines. It shows up in data friction, geography gaps, and narrative lag. That's why we use tools like TrendSpider, QuantConnect, and custom ChatGPT scripts to find setups before the market connects the dots. You're not looking for hype, you're looking for unpriced edge.
Here's where AI shines. Start with TrendSpider. It's not just a charting platform, it's a dynamic scanner that lets you filter by fundamental triggers, revenue breakouts, volume clusters, and RSI divergences. With Condor, we set up a custom screen for microcap energy stocks trading below book value with low float and insider accumulation. CDR popped. Why? Because no one was watching it until the Kazakh gas deal dropped. That's how you find alpha in advance.
Next layer, Quant Connect. This platform lets you backtest trade logic using real historical data. Set your parameters: insider buying, low institutional ownership, new infrastructure agreements, and forward EV/EBITDA under 3 times. It'll return a list of tickers that match your thesis. When we ran this filter in March, Condor scored in the top 2% of energy equities globally. That's not random. That's signal.
And don't sleep on satellite data. Through platforms like Keros and Ursa, AI models now track flaring patterns, pipeline volume, and even LNG tanker routing in near real time. If you had been monitoring the Caspian export zone in late 2023, you'd have seen pipeline flows shift before any news broke. That's the kind of insight AI gives you, not just post-facto confirmation. Pre-news asymmetry.
You can also build ChatGPT prompts to track press release language. Watch for key terms: framework agreement, government partner, infrastructure approval, pilot monetization. Feed these into a daily SEC CDR scraper, and you'll find the next Condor before it re-rates. We've even templated a prompt for you. Scan all TSXV and TSX filings for natural gas or LNG companies mentioning infrastructure, export, or government partnerships with market caps under $100 million.
AI also helps you measure momentum. If you run a trailing 6-month social signal index, posts, tweets, mentions, you'll see that Condor is still invisible. That's good. You want quiet edge. You want setups that haven't hit FinTwit yet. When the signal spikes, the price follows. But if you're early, you own it before the crowd even loads the ticker.
Final AI tip: use overlapping filters. Combine undervalued small caps plus insider buying plus underfollowed region plus infrastructure trigger. That narrows your list to 10 to 20 global names. And here's the power move: run it weekly. You don't need to guess. Let the signals stack.
When you build an AI scanner that prioritizes asymmetric upside, especially in sectors with geopolitical triggers, you stop playing defense, you stop reacting to headlines, you become a discovery machine, and you catch trades like Condor early before the institutions load in and re-rate it to fair value.
In segment 5, we flip the script. What if you don't want to invest in gas stocks, but still want to profit from the LNG arbitrage? We'll show you how to turn this thesis into a side hustle, a media product, or a data play. Asymmetric returns don't just come from stocks, they come from building systems around the signal.
Let's say you love the idea of asymmetric LNG trades, but you're not ready to buy stocks, or maybe you want to do more than just invest. Good, because the same insight that makes Condor a 7x opportunity can also become a business. A dashboard, a newsletter, even a premium signal feed. This is where edge becomes income. Let's break it down.
First idea, the LNG arbitrage tracker. Build a simple dashboard that monitors global LNG price spreads: Kazakhstan domestic, Turkish spot, European import, and US Gulf exports. You don't need fancy tech. Pull daily prices from Trading Economics or Icon, drop them into a Notion or Airtable database, and set alerts for when spreads exceed $5. Why? Because that's when exporters make money, and that's when companies like Condor become extremely profitable. Package this data and offer it as a weekly report. Monetize with Substack or Gumroad.
Or go even deeper. Build a heat map of underpriced energy corridors. Take pipelines that move gas across political boundaries, like TANAP or Central Asia Gas Pipeline, and overlay data on throughput, tariff rates, and seasonal bottlenecks. AI can automate that. Use Hugging Face models to extract infrastructure mentions from government PDFs. If you run a paid Substack or consulting loop, this data becomes edge. And if you offer it to energy investors or macro hedge funds, you've got a B2B product almost no one is supplying.
Side hustle 2, the geopolitical earnings calendar. Build a weekly newsletter that links upcoming export permits, government contract announcements, or LNG offtake tenders with publicly traded companies. Most traders don't know when Kazakhstan will release a new exploration block or when Turkmenistan opens export bids. But this info is often buried in government portals or leaked in energy trade groups. If you aggregate it, filter it, and frame it, you become the edge.
You can even run it all through ChatGPT. Build a prompt that scans 5 government ministry websites weekly and returns any documents that include key terms like gas export, pipeline construction, monetization contract, or joint venture. Feed that into a Notion doc, pair it with a short macro update, and boom, you've got a niche product. Offer the high-level version for free, charge for the annotated analyst version, and again, no competition.
Want something leaner? Build an X account focused on frontier gas plays. Post LNG spreads, insider buys, government filings, and visual pipeline maps with AI overlays. You don't need 100,000 followers. You need 1,000 readers who care. Convert them into pitch page readers, Substack subscribers, or private Discord members. Every insight we've shared about Condor is repackable as content. And the best part? You don't need to be a gas trader. You just need to understand mispricing.
Side Hustle 3 is a bit bolder. Build an AI energy screener for emerging markets. Take the exact methods we covered in Segment 4, Quant Connect filters, insider activity, forward EV/EBITDA scans, and turn it into a digital product. Price it low. Market it to macro traders. Include Kazakhstan, Mongolia, Egypt, Nigeria, Colombia, and Vietnam. These are the new energy frontiers, and no one is building smart, retail-friendly tools to track them. That's your gap.
The point isn't to chase shiny tools, it's to build systems around signal. What Condor shows us isn't just that a stock can go 7x, it's that knowledge, strategic, underpriced, and geography-aware, compounds. If you capture it and reframe it, you can build side income that pays while the trade plays out. That's asymmetric leverage on top of asymmetric capital.
Coming up in Segment 6, we'll bring it all together. The trade, the setup, the asymmetry, the edge, and the real reason Condor could be the best natural gas re-rating opportunity of 2025. Let's zoom out. Condor Energies isn't a high-risk lotto ticket. It's an under-the-radar LNG monetization story with credible contracts, mapped infrastructure, low float, and zero long-term debt. Most juniors never even get to this stage. But Condor, it's already over the line. That alone should force a re-rating. Yet here we are, trading under $2. That's the gap. That's the opportunity.
The asymmetry is so clean, it hurts. Condor has near-term catalysts, long-term cash flow optionality, geopolitical leverage, and government-backed assets. But because it pivoted from oil to gas, and because Kazakhstan sits outside the narrative frame of most funds, the stock is still priced like a failing explorer. That's your window.
What matters here is structural asymmetry. Condor doesn't need a bull market or a miracle drill result. It just needs execution. The pipeline corridor exists. The government deals are in place. The gas is there. The buyers are waiting. And the float is so thin that one catalyst, a permit, a contract, a volume report, can move the price 50% in a week. That's not a theory. That's the playbook.
The math supports it. Even a 40 to 60 million cubic meter annual production profile priced at $6 netback could generate over $150 million in revenue. With conservative margins, that's $60 to $70 million in EBITDA on an $80 million market cap. That's not fantasy. That's modeled upside if execution aligns with existing agreements.
And on the downside, you've got cash on the books, no convertible debt, insider ownership over 20%, and regional demand tailwinds driven by Turkey, Ukraine's reconstruction, and European LNG shortages. It would take active mismanagement or a geopolitical black swan to derail this thesis. That's not zero risk, but it's asymmetric risk. And that's what we build around.
And here's the underpriced factor, timing. We're in a sweet spot. Before media coverage, before analyst initiation, before the first revenue print. That's the period where 3 to 5 times moves can happen on news. And Condor is loaded with news triggers, production updates, export partnerships, pipeline volume confirmations, even a basic reserve upgrade. Any one of these turns the lights on.
In investor language, this is pre-discovery compounding. You enter before capital floods in. You hold through the unlock. And if the narrative catches, natural gas renaissance, non-Russian pipeline exposure, state-level LNG corridors, you're sitting on the front edge of a multi-year valuation shift.
Coming up next, Segment 7. The blind spots, institutional gaps, and coverage deserts that could flip the switch and unleash the re-rating. Because this isn't just about value, it's about timing the re-rate before the herd arrives. So why hasn't the market moved? Why does Condor still trade like nothing changed? That's the final edge, and it lives in the blind spots. This company is hidden behind geography, category bias, and analyst neglect. No Canadian energy fund is modeling Kazakh LNG. No U.S. analyst is scraping Turkish pipeline flows. And no retail investor is scanning CDR filings for framework monetization language in Central Asia. That's why this works. The story hasn't changed. The recognition hasn't happened yet.
Start with coverage deserts. Condor has zero Tier 1 analyst coverage. None. No BMO, no RBC, no Canaccord. That means the funds that screen for covered names will miss it until a trigger hits, like a revenue report or an international LNG sale. And when those models turn on, they don't scale in slowly. They move big. $5 to $10 million in orders on a 45 million share float? That's liftoff.
Then there's the timing gap. Analysts upgrade after flows. Institutions rotate in after media coverage. Index inclusion happens after volume spikes. But asymmetric returns don't live there. They live in the window before the narrative shifts. We're in that window now. Kazakhstan is active. The corridor is open. And Turkey's LNG demand is rising. That's the re-rating phase, and it hasn't started yet.
Here's a detail no one talks about. Short interest is rising, but it's not hedge fund smart money. It's mechanical algo shorts from ETF rebalancing and small float liquidity plays. That creates a powder keg. If a revenue beat or export contract lands, those shorts get smoked fast. That's what happened with $IREN in Q2. It could happen here too.
We also tracked insider filings. Condor management increased exposure during Q4 2024 and Q1 2025. Not just options, direct market buys. That tells you something. There's no dilution scheme, no backdoor warrant games, just real alignment. And that's exactly what early phase institutions look for when they de-risk a small cap.
We'll say this clearly, the asymmetry holds because the coverage hasn't caught up, but the catalysts are lined up. Here's the short list: export volume confirmation, downstream sales contract, reserve upgrade, regional media push, institutional initiation, CDR forward earnings guide. If 2 of those hit, this stock doesn't stay below $3. If 4 hit, it won't stay under $7.
That's your re-rating window. And it's closing. We've seen this play out in uranium, silver, AI compute leasing, even obscure battery metals. Small float, no coverage, real news, and then boom, liquidity gap closes in one move. If you've seen it, you know what it looks like. This is it.
If you want asymmetric setups like this every week, subscribe to the Make Money newsletter at financefrontierai.com. It's 100% free and loaded with tools, models, insider triggers, and our private re-rating calendar. You'll never look at markets the same way again.
If you're building something in this space, energy tech, financial data, AI tools, LNG analytics, pitch it. We'll feature one startup or product each month for free across the podcast. The first pitch is on us. If it's good, the second might be a launch pad.
Follow us on Spotify, Apple, and X. Leave a 5-star review if this gave you real alpha. Or send it to someone who still thinks microcap investing is roulette. This is Edge. This is why we built this show.
Disclaimer time. This episode is for informational purposes only and is not financial advice. Always verify information, assess your risk profile, and consult a professional before investing. We may hold positions in some companies discussed.
The music in this episode is licensed under standard agreements. Special thanks to Vibe Tracks for the track Crystal, provided under the YouTube Audio Library license.
Copyright 2025 Finance Frontier AI. All rights reserved. Reproduction or redistribution of this content without written permission is strictly prohibited.